Hi, Chapter 5, we're getting into receivables and sales. So we've been recording these all along, pretty standard transactions, credit sale, we sell something, creating the asset of account receivable that they owe us, and recognizing the revenue that we have earned this revenue for selling the good or service. So again, pretty standard what we've been doing, account receivable, service revenue, we're good on this. Now, when they pay, of course, they receive cash and then credit the account receivable to eliminate that asset, exchanging it essentially for cash. Um, okay, we're good on that. Basic stuff. Now, other types of receivables, this is where it starts to get interesting. Non-trade receivables from originating from sources other than customers, tax refund, interest receivable, loans, and the word here is a note. So it's a loan, and a note is just not a term we use for a legal transaction, but that's how it originated. It was a promissory note. It was the full term. I promised to pay, and it was written on this documented thing. It's been shortened over time to note, but if you can keep in mind, promissory note, I promised to pay, as written on this piece of paper, a note. That's where it comes from, promissory note, note receivable. All right, so really, really important here. Very kind of tedious little things, and the homework will get into some of these items. Need to know the difference. Trade discounts is on a category by itself, and then sales returns, allowances, and discounts are a separate category. And they all affect the sales that we are that we're recording and how we record them. So let's look at each of these. A trade discount is reduction in the list price of a product or service. Sellers are entitled to receive only the discounted amount. The sale is recorded at this lower amount. It's the reduced price. So FYI, it's a hilarious name. Laser eye surgery 3,000, have a special 2,400. So the entry here is the sale account receivable 2,400, service revenue 2,400. I'm going to notice point out here, and then we'll see it again momentarily. We're not recording service revenue of 3,000 and account receivable and a discount of 6,000 to get to the account receivable of 4,000. A trade discount is a kind of top line initial trade that reduces the amount of revenue that we are expected to receive. The other three types we're looking at, returns, uh, returns and allowances, and other allowances, are after the sale, right? That are contra accounts to the revenue. But a trade discount is category by itself, reducing the amount of revenue that we're entitled to receive. Because hold on to that idea here. So these sales returns and allowances, these are contra revenue accounts, just like we were looking at with accounts receivable, right? In the contra account of allowance for uncollectible receivables, right? It's a contra, and like with depreciation, it's a contra account. It's reported right underneath the other account to which it is contra to reduce and create a net effect, right? So contra accounts, trade discount is not a contra account, but sales returns, allowances, and refunds are. So returns and allowances, a return, I didn't like it, bringing it back, and pretty typical. The company will issue the refund in the same format of which it was received. So if it's cash, they'll refund cash. Credit card, they'll put it back on your credit card. Used to be a scam. You buy it on a card and then get cash back or something like that, or write a bad check and then get cash back. They don't do that anymore. Sales allowances, customer does not return the good. Um, so they're just, it's kind of like an appeasement. The customer's not happy. He's like, hey, let me just give you an after the sale 5% off, 10% off, that kind of thing. So it's an allowance to help earn the customers' return business down the road. Okay. That's an allowance. It's a partial, just a partial refund, but they're still keeping the thing. Okay, so sales return here, pretty straightforward. We're just undoing the return on account. We didn't want it, just undoing it. The allowance is they make that same sale, but now they come back in, they're a little bit unhappy. It's like, all right, hey, you know what? We'll knock $400 off um, of what you owe us, and we're going to record it as a sales allowance, which will be reported as a contra revenue account. And I want to point out one thing real quick here on this sheet that has all the different types of accounts um, for all the different categories. You see over here in the revenue, sales discounts, returns, and allowances are indicated in parentheses. That means in this sheet they are contra accounts. And I see that same thing over here with accumulated depreciation and allowance for bad debts. So when you see those, be thinking contra accounts, that they're listed with the main category, accounts receivable, allowance for bad debts, still listed with the asset, is a contra asset, right? It has the opposite normal balance for whatever the main account is. Okay, so back to allowances here. It's kind of an after the sale discount. Common mistake. Sometimes students misclassify contra revenue accounts as expenses. They are not expenses. Okay, the sales returns allowance, not an expense. Contra revenue. We still want to show the full revenue less the offset of that revenue. Okay. All right. Sales discounts, a different thing. They're written in this term 210 in 30, which means 210 is if you pay within 10 days, we'll give you 2% discount. In 30 is pronounced net 30. If you pay between day 11 and 30, or on day 30, it'll be the full sales price. All right, so the only discount is within 10 days, we'll give you a 10% discount. So a collection during this discount period then sell this eye surgery 3,000, 2,400 during the month of March, sell it to a customer 2,400, 210 net 30. Cash is collected on March 10th, which is within that 10-day period. So I'm going to record it as cash 1960, a sales discount of 40, an account receivable of 2,000. So these debits equal the credit. And what this looks like on the net income, just kind of a snapshot of net income, the 3,000 less that 600 trade discount. Remember, it's in tax terms, it's above the line discount if you think about it that way, or like an off the top discount. Maybe if you're buying a car, kind of take it off the top. It's not even going to get sales tax on it, right? That kind of idea. So that trade discount, 2,400. Um, recognizing the sales returns, 200, sales allowances, 400, sales discounts, $40. This for totaling for that service revenue. Okay, so all these are contra accounts that reduce the contra revenue accounts, reducing the overall revenue count. Okay. So here's what the account receivable account looks like with all these things on there, the T account. So that sale after the trade discount, 2,400, sales return, 200, a credit sale of 200, sales allowance, 400, and then cash collection, 1960 with 40 sales discount, and we're crediting the account receivable to reduce it down to 0. Okay, collection after the discount period then. So they did not get that 10% discount. Got it for um, just paying off or paying $2,000. So they didn't pay off the full amount, but paying $2,000, so cash, and then account receivable there. So a key point here with the revenue accounts, you want to report the revenue that they're entitled to receive. Again, when this is not just for internal purposes, but for publicly traded companies, for a bunch of external stakeholders, for banks and creditors, they want to know how much revenue are you actually generating? They will separately look at what are returns and allowances and those types of things, but they want to see, and usually the bigger revenues, the better, that your products are desirable, people want to buy them, and then the returns and allowances, those would be more quality of the product and customer satisfaction, which is a different but still important variable to consider. But you need to record the full revenue for what they're entitled, initially at least, to receive. And then remember, trade discounts are off the top. All right. Now we will, in this next section, look at the end of period adjustment for the contra revenues because we don't know what those are going to be, right? We're estimating, we've got all these accounts receivables, and I've been hinting at um, that it's not reasonable to expect that 100% of our customers will pay us what they owe. It's just not reality. So we have to create estimates for how much we think they're going to pay us. And that will be in the estimation section we'll look at next. See you in the next section.